Hi, welcome back to another episode of the Mortgage Musketeer, where today we're going to be talking about the next episode in our first-time homebuyer class in our series. And today we're going to be talking about how much money do you actually have to put down, what all goes into the down payment, how are rates impacted by that, and what about mortgage insurance? So it's a lot to unpack, so let's go ahead and just dive right in. So first of all, how much do you need to put down? The answer to actually most of those questions is it depends. Depends on you. All right. What is your credit score? How much do you have to put down? And how much debt do you have? Because all that goes into your debt to income ratio, plus how much are you actually able to put down. That impacts what your mortgage insurance is. That impacts what kind of loan product you have. All those things go together. So when people call and say, hey, what rates do you have? Or, whatever, I don't want any MI. A lot of times people are influenced by friends and relatives, and in the Army we actually had a name for that, and it was called, and that sounds really bad, but the idea is people think that they know what they're talking about, and most of the time they really don't. They know enough to be dangerous, which is why I'm creating this series, so that I can eliminate all of the people who think that they know what they're talking about and tell you exactly how it works. Eliminate any of the confusion. So as you go through this, if you learn anything, be sure to subscribe, please. Share it with everybody that you know, and give me the thumbs up. I really appreciate it. Okay, so first of all, how much do you have to put down? Well, that really depends on the loan product. So let's talk about those really quick. You've got your VA loans, you've got your USDA or rural housing, you've got FHA and conventional. There are other types of loan products, but those are the four primary, and everything off of that is kind of a hybrid. So if you're thinking about those four loan products, especially as a new first-time home buyer, if you are a veteran, that's a VA loan. It's a zero down loan. I'm going to do a separate video on that one, so we'll set that one aside, but it is a zero down loan. If you are getting a USDA loan or rural housing, that is also a zero down loan, but understand that that's difficult to get into. And I'm going to do another video specifically on that in this series so that you can break it down. But VA and USDA are really your only two zero down loan products. If you're not a veteran and don't qualify, that's out of the picture. If you don't qualify for a USDA loan, which it's actually one of the harder loans to qualify for, then that doesn't apply. Now, if you do qualify for it and you're buying in a rural area, fantastic loan. Okay. Most people, though, are going to fall into FHA or conventional loans. FHA loan, the minimum down payment is 3.5%. The minimum down payment for a conventional loan is technically 3%. But the question is, does that make sense? Everybody is different, and your loan officer will check your scenario and figure out, does 3% make sense to you? As a rule of thumb, you can think either 3 or 5% down at a minimum. You do not need 20% down. All right, contrary to popular belief, you don't need it. So if somebody says, well, I don't want any mortgage insurance, then the first question that I ask is, well, how much money do you have to put down? All right, there are other programs where you can actually buy out your mortgage insurance, but technically that defeats one of the reasons that you don't want mortgage insurance, for the extra payment. Or, there's a recapture value, and does it make sense? How long are you going to be in the home? How long before you would refinance? What is your actual financial situation with credit score and everything else? There's a lot that goes into it. So none of those are simple answers. So when people call up a loan officer and say, well, I don't want mortgage insurance, or what is your rate? Or, whatever the case, it's not that easy. So your loan officers are going to say, well, it depends. Or they might seem like they're trying to waffle a little bit, and they're not. And the reason for that is because you can't know until you pull credit, which is why the very first video I said you got to get your credit pulled. Because in order to do an accurate assessment of what you actually qualify for, we have to know A, what your credit score is, and B, how much your debt is, and C, what is your income, and then throw in your assets, how much money you have put down, and that all kind of shapes what kind of loan product you have. So when I'm talking to somebody on the phone, if they're like, well, you're not going to pull my credit, I say, okay, and then I kind of walk through the process. And I can eliminate certain things. Are you a veteran? No, gone. How much do you make? And I can kind of whittle things down to an area, but it's not accurate. So if you really want to know what's going on and you really want your loan officer to help you, get your credit pulled. I know it's a dead horse at this time, but you got to do it. Okay, and once you do that, then your loan officer can really work to hone down on how do they make your money work best for you. At least that's what they should be doing. How do we make your money work best for you? All right, so having said that, now we know the minimum payments that you're going to put down. What does that really mean, and how does that impact us? Okay, so what goes into a monthly payment? A monthly payment consists of your principal and interest, and that's nothing more than the loan amount versus the interest rate. Okay, then you have your homeowner's insurance. Sometimes it's called hazard insurance. Then you have your property taxes. And then if you have mortgage insurance, if you're not putting 20% down, you're going to have some portion of mortgage insurance, and it varies. Then those four factors make up your actual payment. If you're going to purchase in a place that has HOA fees, that goes into it as well. So that is part of your debt to income ratio. So you have to know that when you're actually looking for a home. Not counting the HOA fees. If you're buying a condo, critical that you know the HOA fees. But if you're not doing that, then those other four components are going to be what makes up your payment. So when you're using those online mortgage calculators, which are very rarely accurate, you're going to think that your payment's going to be like $700, and it could be $1,000, and it's because it's not factoring in a lot of those items. Okay, and that's a really important thing. So you see it all the time, all these loan calculators, and it's good for your principal and interest, but understanding what your homeowner's insurance is going to be, knowing what your property taxes are going to be, and knowing what your mortgage insurance is going to be. Those are all important factors that go into your payment. All right, with rates. Now, I can't talk specifically rates because of all the guidelines that are out there that prohibit us from doing that unless there's very specific things. I'm just going to talk generalities with rates. All right, so interest rates are tied into many things, and that's why it's difficult when somebody says, well, what are your rates? It's one of the questions that you just want to slow down. All right, and the reason for that is because credit score. So pricing for rates, and that's how that works, is rates they go off of a rate sheet, and there's a lot of factors that go into it. And of course, the first one is your credit score. What is your credit score? And typically, they go in like 20 bucket increments, 20 point increments. So anything above a 760 is A plus credit. Between a 740 and a 759 is A credit, and you can walk it back down in 20 point buckets. So understanding that, you're going to know that you have different rates throughout that scale. For conventional loans, anytime you get below a 780, you're going to get beat up pretty good on the interest rate because that's just the way it's structured. That's how the rates go. There's more risk. The lower your credit score, the riskier you are. The lower your credit score, you might end up being put into the FHA loan. So anywhere below a 680, you are most likely going to fall into an FHA loan. All right, and the reason for that is because there is additional risk with a lower credit score. So people think, well, I only need, whatever. Technically, you can get in. Most lenders these days will work with a 580 if you can get approved eligible. 620 is better. Anything above a 640 tends to eliminate layered risk that comes along with lower credit scores. So if you're in that range, you're probably going to fall into the FHA category. And there's nothing wrong with that. People say, well, what's the best loan? And my response is normally the best loan for you is the one that actually gets you into a home, right? So if you're looking to buy a house, then you want to be able to just buy a house. There's other factors in your life that have happened that are going to put you in whatever loan product that you are. And then if need be, later on you can always refinance out of it. Okay, but if you're looking to buy a home, an FHA loan is a fantastic loan. Now, an FHA loan carries with it a little bit of risk because of the credit score or because your debt to income ratio is too high. So if your debt to income ratio is too high, you also may fall into where you have to go FHA. Okay, or if you've had a bankruptcy in the past or foreclosure in the past, you may end up going FHA. And again, they're great loans. Right, now the thing that you need to know about an FHA loan is that it comes with mortgage insurance. And there's a couple pieces to that. First, it comes with an upfront mortgage insurance premium. and that is, as of the time of this video, it's 1.75%. All right, so 1.75%, and then that upfront mortgage insurance premium is rolled into the loan. So what happens is, because it's rolled into the loan and you have this upfront mortgage insurance premium, FHA mortgage insurance is reduced to 0.85% if you've put 3.5% down. If you put 5% or more down, then it's going to be 0.80. And it's a flat calculation. Just easy. If it's an FHA loan, here's what your mortgage insurance is. Now, depending on the size of the loan, that can change your payment. Again, which is why it's not so simple to see what you actually qualify for, because we got to plug in all the numbers. On a conventional loan, anything, if you don't put 20% down, then you're going to have mortgage insurance. And this is one of the reasons I said that, yeah, you can do a 3% loan. Now, there are products called Home Possible and Home Ready. They do have an income cap, so if you make too much money, and it's by zip code, if you make too much money, you don't qualify for that, and it's just out of the picture. But there is a 3% loan that you can get into if down payment is the issue and you've got a great credit score and low debt to income ratio. The question, though, is, what is the mortgage insurance on that? Because with 3% down, your mortgage insurance tends to be higher. So on conventional products, your mortgage insurance is determined by several different factors, to include your credit score. It will be factored into how much are you putting down as to how much they're going to require. And there is a little bit of debt to income ratio that can play into that. So there's a couple different mortgage insurance providers for conventional loans, and there are some companies that have special deals on them, like United Wholesale Mortgage, for instance. They have reduced mortgage insurance, so sometime utilizing them is a pretty good deal. You can also get your mortgage insurance rolled into the rate, so you can have a slightly higher rate and no mortgage insurance. The question is, does that make financial sense? And again, it depends. That's just another loan product option for you. If you don't want the mortgage insurance and you know that you're only going to be in the home for a certain period of time, but you need to look at recapture value and some other things to see if that really makes sense. So to kind of break this down and put it all together, what you need to think about is, if you're putting 3.5% down on an FHA loan, you're going to have mortgage insurance for the life of the loan until you refinance out of it. So what a lot of people do is, once they reach an 80% loan to value, then they refinance and get out of their mortgage insurance, if it makes financial sense. With conventional loans, it's all about, the mortgage insurance is all about the 80% loan to value. Once you reach an 80% loan to value, you can request that your mortgage insurance be removed. Once you reach a 78% loan to value, it's going to go away on its own. Right. So that's kind of how the mortgage insurance works. Just understand that it's going to be part of your payment. A lot of people try and avoid it, but it's not necessarily bad. It just depends on a lot of factors. And what you need to, the real question you need to ask is, well, how much is the mortgage insurance going to be? And then your loan officer is going to say, well, I don't know. We need to see. If you're pulling in the credit, they can get you an answer for what your mortgage insurance is going to be. They can get you an estimated payment. Most loan officers have a lot of just experience knowing what your homeowner's insurance is going to be. So they can dial down your payment and get relatively close. Okay? So those are answers that, as long as you are actually interested in seeking the answer and helping your loan officer with the pertinent information, that's part of pre-qualification, part of pre-approval. You should know what your payment is. And they should be able to quote you what a rate is based upon your credit score, your debt to income ratio, your loan to value. Okay, they should be able to price it out, and that's one of the advantages of being a broker or a lender who utilizes multiple different investors, because you can shop around. And that's the advantage. One of the advantages, and I'll cover that more in detail, but that's one of the powerful aspects of not just being a bank, right? Because a bank kind of oftentimes it's kind of cookie cutter. It's like, here you go. They have loan products as well, but they only have one set rate for your situation, where if you're dealing with a broker or somebody who deals with multiple investors, then they can shop around. They basically compete for you. They figure out, how do you make the money work best for you? How do you get the lowest rate? And based upon your situation, which lender is going to help you close the loan, because not all of them are the same. But I digress. Okay, so Those are the big things. Is what goes in your payment, and how much do you need to put down, and how are rates impacted in relation to the different loan products. That is a question I will answer right now. So conventional rates tend to be a little bit higher than your government rates. And the reason for that is because you have the government-backed situation with the upfront mortgage insurance premium, and they just tend to have lower interest rates. So what ends up happening is people will see what the rates are, on TV, and then they're like, well, I saw rates are at like 2, whatever. That's not exactly what rates are at. You have to actually figure out, when you're talking to your loan officer, where are rates in relation to the investors and your qualifications. All right, so that's why it's so key that you gotta go through this process to know where do you actually stand. With USDA loans, those are also a nice loan rate, and I need to touch on that too. So USDA loan, the mortgage insurance is 0.3. It's 1% upfront mortgage insurance premium and 0.35% monthly. So it's a little bit less than an FHA loan, which makes it a good deal. It's a zero down and a little bit less on the mortgage insurance. But again, you have to fit a very specific parameters, and you have to be in a rural area. If you're living in a city, you'll never get a USDA loan, okay, because it's for rural housing. And then VA loans, and the reason that they're so awesome is because there is no mortgage insurance. Okay, you have a funding fee. I'll throw the video up here about the VA changes so you can see how that works. And I'll do another video really focused on both VA and USDA. I've had that requested already, so that's on the horizon in this series. Okay, so hopefully that answered some of your questions and gives you a good overview so you understand how that works. And if you have any additional questions, put them in the comments below. I'll get you hooked up. I'll answer anything that you need to know. And then if I have missed anything that comes up, then I'll add it to this series as I go along. All right. Until next time, remember, it's all for one and one for all. And if you are following this series, we're going to set you up to be able to buy a house as soon as possible. Until next time.